Welcome to Dezan Shira&Associates series of podcasts. My name is Cynthia from the Beijing office. With me today is Chris Devonshire-Ellis, founder of our firm. Dezan Shira&Associates is a specialist foreign direct investment practice, providing corporate establishment, business advisory, tax advisory and compliance, accounting, payroll, due diligence, and financial review services to multinationals investing in emerging Asia. Since its establishment in 1992, the firm has grown into one of Asia's most versatile full-service consultancies with operational offices across China, Hong Kong, India, Singapore, and Vietnam, in addition to alliances in Indonesia, Malaysia, Philippines, and Thailand, as well as liaison offices in Italy, Germany, and the United States. Today we'll be talking about how can Chinese foreign invested entities take advantage of ASEAN. So Chris, why don't you tell us about what ASEAN is?
ASEAN, or the Association of Southeast Asian Nations, is a 10-country bloc that since 1967 has been working towards free trade throughout the entire ASEAN region. And ASEAN itself comprises Brunei, Cambodia, Indonesia, Malaysia, the Philippines, Laos, Myanmar, Singapore, Thailand, and Vietnam. So it's pretty much most of Southeast Asia. Now, within those countries, there's quite a lot of diversity. It includes Singapore, which is really the financial and services hub for ASEAN. It should be remembered that Singapore is the only ASEAN member that has a fully convertible currency, which makes it a great hub for being able to manage other operations elsewhere in ASEAN, such as treasury management and these sorts of things. So Singapore has a specific role as a de facto financial center for ASEAN. There are other countries, such as Indonesia, Malaysia, the Philippines, Thailand. These are large manufacturing-centered economies, and their economies are growing significantly with increasing amounts of foreign direct investment into manufacturing and then selling those on to both ASEAN and to other countries worldwide. Some of the other members of ASEAN have their own particular characteristics. Brunei is essentially an oil-rich state. It's a small Muslim nation and is important for companies and trading in oil and related industries, but essentially that's what it does. The other members, Cambodia, Laos, Myanmar, and Vietnam, are relatively less well developed, with perhaps the exception of Vietnam. Now, these four nations that I've mentioned, they are not yet fully in compliance with ASEAN's own free trade, and the ASEAN Economic Community, or AEC for short, won't actually come into full compliance until the end of 2015. When that happens, there will be complete free trade between the region, and with Vietnam coming into compliance by the end of next year, that has particular implications for trade with China. It has a long China border, and Vietnamese manufacturing has already been competing with China for foreign investment. China itself has a free trade agreement with ASEAN, which came into effect in 2010. And the impact of that agreement is that it has reduced tariffs on 90% of all goods traded between China and ASEAN, and vice versa, to zero. This means that it is now possible to take advantage of the lower cost ASEAN manufacturing countries, such as Vietnam, Indonesia, Philippines, and so on, to manufacture goods in ASEAN where wages are considerably lower, and then export them duty-free to China. This is going to be an ongoing trend. China's middle-class consumer market, which is today about 250 million people, will increase to 600 million by 2020 in the next 6 years. Now, when you have that new emerging Chinese consumer growth, but wages in Vietnam of about 22% of the current wages, average wages for workers in China, then it makes considerable sense to base manufacturing capacity into ASEAN nations and use the China-ASEAN Free Trade Agreement to reduce tariffs and then service and sell to the China market from an ASEAN manufacturing capacity. So the relationship between ASEAN and China is only going to get stronger. China is already ASEAN's largest trade partner, and vice versa. And the impact of increasingly expensive wages in China, a newly emerging and massive consumer market, and developments and infrastructure improvements in ASEAN will only mean that trade between the two entities, China and ASEAN, is just going to boom. So for China-based businesses, looking at ASEAN and the strategies on how to take advantage of it and deal with the implications of this are extremely important.
Thank you. Please provide us some tips for market entry in ASEAN using Singapore, or using holding structures, and other tips that you might have for audiences.
Okay, thanks. Well, Singapore, as I mentioned, that is really the regional financial and services centre. It's attractive because it is a fully fledged member of ASEAN, so Singapore companies can open up subsidiary operations in ASEAN, manufacturing operations, reporting out of the Singapore office, but taking advantage of the free trade that ASEAN offers between its neighbours, but also with the free trade agreement I mentioned with China. ASEAN also has a free trade agreement with India, which is similar. So using ASEAN as a base to manufacture goods in ASEAN and then export onto the China and India markets and elsewhere throughout ASEAN makes a lot of great commercial sense. The benefit of Singapore is that its own infrastructure is excellent. It is the largest port in the world. Its financial services and HR operations, IT operations are all first class. It is consistently rated as first in the ease of doing business rankings globally. So the infrastructure in Singapore is excellent. As I mentioned earlier, it is also, amongst all of the ASEAN countries, Singapore has the only fully converted currency, which means that it's a great location for being able to manage and monitor financial operations for a business which is investing elsewhere into ASEAN. It also has a stock exchange, so developments of factories elsewhere, perhaps in Vietnam or Indonesia, so on and so forth, when they become successful and more money perhaps is needed to be raised to expand those business operations elsewhere in ASEAN, these sorts of holdings can be listed in Singapore and raise money there. So it's a great economic and development hub for ASEAN. Singapore also offers very attractive tax rates. Its corporate income tax rate is 17%. There are also incentives given for SMEs, tax reductions and these sorts of things which are applicable. There's also no dividends tax on profits realised out of Singapore, so if you make money in a subsidiary operation, you can bring that money back to Singapore and without penalty, and then redistribute it from there. So all in all, a low tax jurisdiction, ease of doing business is excellent, the infrastructure is excellent, and it really is the gateway to Southeast Asia. And through the free trade agreements that ASEAN has with China and India, it's also a gateway to these markets as well. So Singapore, great place to do business. Everything works there, and transparency issues are also very high. Everything works in Singapore. Great place to be based for doing business in Asia.
Thank you very much, Chris. Your insight on this topic is very valuable. Thank you for joining us today. For further insight into regional economic environment in Asia, please visit our publishing subsidiary Asia Briefing at www.asiabriefing.com. Here you can find news, commentary, magazines, guides, multimedia, and more, which help guide foreign investment in emerging Asia.